Hi, welcome back. It's part 4 of debunking the investment myths that can destroy your long-term returns. I'm Jason Labrum and
Alex Klingensmith.
There you go. Alex is in the house. Now we've got this down. I think it's the way I pause, Alex. It's like the Jason Labrum and then you go, or I say Jason Labrum and Alex Klingensmith. I don't know. We're going to keep talking about it.
How do they do it on All In? I mean, I feel like you listen to that podcast a lot.
I haven't been lately. I can't.
Right.
They got to stop talking about politics. That's all they're talking about. Yeah, I don't know.
I finally listened to it for the whole thing, and now you're out. You're done. You're taking a break.
Taking a little break. We're breaking up. We're taking a break. All right,
But my point is that Jason on that show introduces everybody. They don't ever have to introduce themselves. I think.
So should we do that?
I don't know. Maybe I'm wrong.
I can introduce you guys. And now Jason Labrum.
There we go.
Oh, his voice is so much better.
Producer Brian has it now. Sounds kind of like a stage at a gentleman's adult club or something right there.
And Alex Klingensmith coming to the stage.
Oh, boy.
Oh, dear. Here we go. All right. So
let's get into it.
In a hard turn away from our focus here, we're on part 4, debunking investment myths. We're going to talk about the last 2 here. So as you're seeing our slide, if you're watching us on YouTube, always please give us a subscribe, a like, and ask us questions. If you have personal questions you want to talk to us one-on-one, we're available. We'd love to hear from you. But we went through all of these topics here through the part 1, part 2, part 3, sell in May, go away, market timing, wrong time to invest, so on and so forth. You see them all. We're going to close it out on part 4 here with a high dividend yield means safe investment. Oh my gosh, I've heard this one before. And also, bonds are risk-free. Of course, they're bonds. They're safe, right? Well, let's dive in. All right, so high dividend yield indicates a safe investment. Now, I've heard a lot of investors say to me, I just buy dividend stocks and I'm good. All right, if you buy a well-diversified portfolio of dividend-paying stocks, you are good. You're probably good. But does it necessarily mean that it's totally safe just because it pays a dividend? What do you think, Alex?
Well, I'm going to go back to what I learned. I think it was 13 or 14 years ago when Olivian was teaching us about the total return strategy, right? Dividends, interest, gains. And I've since embraced that in the way that I like to communicate this concept to clients, prospects, clients, just people in general, is that no one thing is going to help you accomplish your long-term goals when it comes to investing. Not dividends, not interest, not gains. All 3 will work together, or at least 2 out of 3, right? If you don't want any bonds at all, you're going to have dividends and gains, or conversely, you're going to have interest and gains if you don't have bonds only. But if you're only looking for dividends, for dividends, this chart's great and showing you there's some material problems with that strategy, right?
There is. I mean, I think what happens oftentimes, a company will be paying a high dividend as sometimes a sign of it's in trouble. And you can see through the examples here, some known companies like Redwood Trust, New York Mortgage, Western Union, Kohl's, Carter's, 10-year total returns down 50, 60, 20, 30%, even with the dividends. So just because a stock pays a dividend doesn't mean it's safe. You got to think of total return. That's appreciation, that's dividend or interest. There's one more slide on this that's also interesting, right? When you look at investors perceiving high dividend yields as an indication of secure investments. But again, they sometimes are telling you there's something wrong with the company and why the dividend yield is high.
I think there's a generational thing here too. And this is a theory. So please don't show me a slide that tells me otherwise quite yet. But that book I was mentioning on one of the earlier sections of this series, The Psychology of Money, talks about how each generation has different sort of realities based on how they grew up and what they grew up around. I think dividends, and again, I'm not trying to put myself into one category or another. I'm only a student of it, really. But I think the younger generations they're like, why do I care about a dividend? Tesla's never paid a dividend. It's been a great investment as a stock. I don't even know if does NVIDIA pay a dividend?
No.
Okay. Or if they do, it's probably not a relevant point of why you'd buy it.
So you wouldn't buy it for the dividend for sure.
Generationally though, like blue chip dividend paying stocks is a thing if you're a boomer, right?
Yeah, totally a thing. And look, I mean, it can be a part of a yield. I think the message here in debunking this myth is that because it pays a dividend doesn't mean it's a good investment. I mean, Xerox being the perfect example that they continue to raise their dividends. So you can't also go chase, I buy stocks that have historically raised their dividends, because you're going to have some real dogs in there. They're historically raising their dividend is the only way to keep people to stay invested in the stock at all. And yet it goes down 81% over a almost 10-year period of time, but they raised the dividend. So it's not necessarily a good indication. Now, it's not a bad indication. We're not saying we don't like dividends. I love dividends. I think you want to make sure of the full financial strength of a company and the investability of a company, or companies, better said, before you go just chase a particular yield. Really scary when you look at like closed-end funds and different types of investments where the yield may be return of capital, the yield may be based upon leverage and kind of manufactured yield, and then it can be really scary. You could be holding a ticking time bomb. We've got to debunk that myth that a high dividend yield means it's a safe investment. Not necessarily so. If you've been with us for all 4 parts of this, we really appreciate you hanging on. And I hope you learned something, and I hope you are a better investor and you're financially detoxified because of it. Our last slide in part 4 here of debunking investment myths is bonds. I need to own bonds because they're safe. Are bonds totally risk-free, or can they be affected by things like inflation, interest rates, and default risks? Wow, is this a great time to talk about this slide, right, Alex? Thinking back to 2022, interest rates went from 0 to 5%. It was the worst performing year for bonds on record. Super scary time for bond owners. In fact, the next year, 23 and 24, have not been very good either, as interest rates not only went up, but they stayed up. So bonds have had lots of volatility, and it's been a tough road for bondholders.
I remember at the beginning, or no, it was probably the middle of 2022, Jason, we like to host events for clients and for prospective clients for, we do education events, and we also do like appreciation events where we just have like dinner and sometimes a speaker or something. And do you remember the event that we did towards the end of 2022?
Refresh my memory.
So we did it at the Crossings, which is a really pretty location here in Carlsbad.
Nice spot.
Yeah. Probably 150 people showed up, and we had an illusionist.
Oh yeah, that was so cool.
And we didn't talk about markets at all that year, that event. Do you remember? Because of what was happening that year? Not to mislead anybody, but simply because people came because they wanted to hear what we had to say, but
they wanted a break from the market. Stocks were down, bonds were down. Hey, we're having that same illusionist back to our advisory board meeting.
Oh, really? And the same guys?
Same guys coming back. He's so cool. He will freak you out. I mean, it's unbelievable. So, I mean, you think about illusionists. Good topic, Alex. What a segue. And illusions of myths and investing, right? There are lots of illusions out there. And no matter what your generation is, there's a different illusion or a myth that you got to debunk. I think that this comes from an older generation of, bonds are risk-free. But when you look at longer term bonds, they've carried almost the same amount of risk of stocks, 13.6% volatility or standard deviation, where stocks have been 15. As you get more conservative in the bonds, yes, they get less risky, but that's a good point in and of itself, is that there are lots of different categories of bonds, right? There's long-term, there's low quality, high quality, short-term. And so lots of different kinds of bonds, but generally we got to debunk the myth. They are not risk-free investments. And again, I'd go back to what does risk mean versus volatility, so on and so forth. So I hope you enjoyed our series, 4-part series on debunking investment myths. Check us out, YouTube, give us a like, a subscribe. It's fun to do this. We hope you enjoyed it, and we'd love to answer any questions that you have individually. You can work with us at IDA Wealth if you're looking for individual help building portfolios, financial plans, and in just investing better to make sure that you have true financial peace of mind. I'm Jason Labrum with Alex Klingensmith, and it's Financial Detox and IDA Wealth. Thanks for checking in and tuning in. We'll catch you on the next show.